TQQQ is a triple leverage version of the Invesco QQQ, a popular ETF tracking the 100 largest companies on the Nasdaq. TQQQ is a really powerful tool that you can use to compound your money in a matter of months, but in a bear market, you're really screwed. Should you invest in TQQQ to become a millionaire, or is it just another way to donate all your money to quants on Wall Street? Alright, you're going to be hearing a lot of Qs in this video, so from now on, I'll refer to TQQQ as triple Q, and regular QQQ is just Q. Triple Q uses complex financial derivatives to leverage Q, but you don't really need to understand that for now. By its nature, triple Q is extremely risky, and everyone will tell you that it's a short-term investment vehicle that's only meant to be used for less of a day because of quote-unquote volatility decay. Conveniently, they leave out the fact that volatility decay isn't necessarily a bad thing. Let me explain. So someone might assume that triple Q cures no risk because if you just wait, stocks will eventually go up and you will always get 3 times the return compared to holding triple Q. Unfortunately, if it was that simple, everyone would be millionaires. The problem is that returns compound over time. Here's an example. Let's say markets are very volatile and Q goes down 20%, then up 20%, then down 20%, then up 20%. Q would be down 8%, but triple Q would be down 59%. Way more than triple of what Q returned. Like I said, this actually helps when stocks do well. For instance, let's look at the bull run between 2010 and 2021. Q went up 829%, but triple Q went up, get this, 19,000%. Instead of leveraging 3 times, triple Q leveraged close to 25 times. If you had invested $10,000 into triple Q in 2010, you would have walked out with $1.9 million. If you look in the full story, factoring in 2022 as well, triple Q crashed almost 80% in 2022. But even after the pummeling triple Q received last year, it still would have vastly outperformed regular Q. That's still insanely biased. After all, as aforementioned, that was the conditions of a huge rally, especially in big tech stocks that happen to be the top holdings of Q. This is why most people call holding leveraged funds for more than a day the 8th deadly sin. But this mindset is really stupid. Here's a backtest of how you would have done if you had pursued leverage over the past 100 years. Keep in mind that the scale is logarithmic. It absolutely pisses me off when people spam quote-unquote backtests of triple Q from this fund's inception. 2010s were literally the best conditions for the market in history, so of course it would have done amazingly. But this is 100 years. If that isn't enough data for a backtest, I don't know what is. Despite the fact that it started off with a huge crash because of the Great Depression,
the economy's great and it'll probably be great forever. Just kidding.
We ended up outperforming by around 3 times by the end. However, as you can see, there are entire 20-year periods where you would have been in the red if you bought triple Q. This is 1929 to 1954, 1969 to 1986, and 1999 to 2021. Even if triple Q has insane returns during a bull market, it doesn't matter if you already lost everything. If you invest before a crash, then you're unimaginably screwed. The main problem is that returns are multiplicative, not additive, which, like we covered, helps during a bull market, but during a crash, well, your financial future is wrecked. But I'm writing this after a crash. Triple Q is down 40% from its 2021 high at the time of scripting. Sure, it already went up like 160% in 2023, but who knows? The next couple of years could be a raging bull market, or your uncle might finally be right and the global economy is going to collapse. But one of those possibilities seems a lot more probable than the other. Q itself is seen as a dubious investment since it comprises of large-cap tech growth stocks, which are insanely overvalued after the last decade. There's really no reason for big tech companies to be worth trillions of dollars. Historically, the Nasdaq 100 has actually underperformed the S&P 500, and it looks like it's due to underperform in the next decade as well. It's really only popular because of its performance in the 2010s. Due to that reason, if you're looking for triple leverage ETFs, I would go with UPRO, a triple leverage version of the S&P 500. After all, the S&P 500 is just a slightly more diversified version of the Nasdaq 100. If you are going to invest in a leveraged ETF, you need to have a hedge, which are key to protecting against market crashes. Famous portfolio called the Hedge Fundy's Excellent Adventure, which is 55% UPRO and 45% TMF, which is 3 times treasury bonds. This strategy significantly outperformed the market and is worth looking into. I'm going to be uploading a video specifically about it pretty soon, so subscribe to make sure you don't miss out when it comes. In conclusion, TQQQ is a beast. After the recent market drawdown, TQQQ could be an insanely powerful tool. However, you have to make sure you understand the risks of leverage investing. You might also want to consider buying the aforementioned UPRO or QLD, a 2 times leverage version of QQQ. No matter what you do with the power of leverage, just remember these essential words of wisdom. With index funds, time in the market is key. With leverage funds, timing the market is key. I hope you found this video informative or at least entertaining. Please like, comment, and subscribe to boost this video in the cruel YouTube algorithm. As always, I wish you green in your portfolios and I'll see you in the next one.